If you have excess cash savings and you like the sound of tax-free investments, stick around because we're talking about how to utilize cash in a counterintuitive way in an effort to maximize your tax-free investment holdings. Let's get into it. So one tax strategy that I'm working with constantly is Roth conversions. Now, this is getting into some jargon. Basically, a Roth conversion is when we're trying to get money that's in a pre-tax retirement account into an after-tax retirement account. So why do we want to do that? Well, first of all, here's just very high level. I'm going to try to keep this basic and as short as I can. There's two basic buckets for saving retirement dollars. You have a pre-tax bucket, and I would say all the people that I encounter, I'd say it's 10 to 1 in terms of where retirement dollars are. $10 in pre-tax accounts to $1 in after-tax accounts. But anyway, the types of accounts we see up in the pre-tax area are, your typical 401k, traditional IRAs, pensions. And from a tax perspective, money goes into these accounts on a pre-tax basis. And the downside is when it comes out in retirement, it's 100% taxable. So you're paying all the tax when you're in retirement. Now, in contrast, there are these after-tax savings vehicles or retirement accounts where money goes in after tax, it grows tax-free, and it comes out tax-free. This, of course, is the Roth IRA, and we could also throw Roth 401k in there. Now, obviously, tax-free sounds awful nice. There's a couple other added benefits to having money in these after-tax buckets. Specifically, let's just focus on the Roth IRA. The Roth IRA is not subject to the required minimum distribution rules, and also when the dollars ultimately pass to your beneficiaries, they pass income tax-free to your beneficiaries as well. So for all these reasons, when there's an opportunity, we want to shift dollars from these pre-tax accounts over to these after-tax accounts. And this is most commonly called a Roth conversion. So clearly there are some attractive features to the after-tax bucket, specifically Roth IRAs, in contrast to those pre-tax retirement savings accounts. So why doesn't everybody just run out and convert? Well, quite simply, because you have to pay the taxes to do the conversion. And further, if you withhold the taxes from the conversion itself, it makes the strategy just look less attractive. So for example, let's say Bob wanted to convert $100,000 of his pre-tax savings, his pre-tax retirement accounts that is, and we'll just assume he's going to be in the 22% federal bracket, 7% state income tax. So $100,000 converted, assuming he withholds the taxes, is only going to net him $71,000. So it's nice to get it into the after-tax bucket where it's tax-free forever, but he's taken a pretty big haircut to do so. And herein lies the opportunity for folks who have a big pile of cash that they don't really have anything to do with it. Let's say Bob was in that case. Let's say he had, a couple $100,000 just sitting in the bank doing nothing, eroding away with inflation. Well, Bob, what he could do is convert his entire $100,000 into the Roth and pay the income tax out of those cash savings that he has on the side. The result of that is it maximizes the amount of dollars that he's converting from a pre-tax into that after-tax savings bucket. Now, there's one other reason that I just want to mention why I think this is a somewhat timely opportunity. That is to maximize Roth conversions. I think very few people know about this, but tax rates are set to go up at the end of 2025. So we had a big tax cut in 2018, but here's the important point. Those tax cuts, the way the law was written, are not permanent. They are set to expire, and tax rates therefore are going to revert back to where they were prior to 2018. So here are the current marginal tax brackets today, and here's where they will be going, just assuming Congress does nothing, okay? So obviously, anything can happen. A new tax law can be written and so forth. But if you want to hedge against what is current law, that is tax rates going up after 2025, maximizing Roth conversions right now looks like an interesting opportunity. So again, if you have a big pile of cash just sitting around getting eroded away by inflation, utilizing that cash to pay taxes, I think this is kind of counterintuitive, But paying taxes to maximize your Roth conversions now, especially knowing that tax rates very well could be going up in the very near future, might end up being a very good opportunity to utilize that cash. Well, I hope that was helpful today. Definitely kind of an alternative perspective or out of the box approach for strategically utilizing cash. So my focus is working with individuals, mainly 55 plus, doing retirement planning and really trying to coordinate the main pieces of the puzzle. You know, the investments with the income strategy and the tax strategy. If you're interested in that, please feel free to reach out, and at the very least, give me a thumbs up if you enjoyed the video. It really helps get the message out. Thanks for watching, and I hope we'll see you on the next one.